Should we buy or sell the 20-year Treasury Bond ETF? So first off, read this disclaimer carefully. Then do your good deed of the day by liking and subscribing. So, on Fixed Income 360, we have an ETF called the 20-year Treasury Bond ETF. You get exposure to government bonds, 4.6% away from the 52-week low, minus 27% away from the 52-week high, which is a lot in the bond market. So this ETF is definitively affected by interest rates, but it's also very important to just be aware that it's about the market's expectation of interest rates. And that is where it gets very complicated because the market will react to what they think will happen in the future, not necessarily the present interest rates. So yes, you can see that this ETF has fallen down to a major horizontal support. The primary thesis would be that the bulls will buy this level. If we were to see the bulls not muster confidence to buy this level, then we could see substantially lower prices for the TLT. So this is a major setup, big deal. We have seen head and shoulders patterns before with this ETF, like here, here, and here. But at the lower end of that, right shoulder was the buying opportunity. Here we got a head and a shoulder, but you didn't get, that, measured move breakdown. You actually had a low form. And recently we have seen, a major head and shoulders that has pushed us, way back to the beginning of the left shoulder. Looking at the history of this ETF, it has sort of done this thing multiple times, as we can see. Hence, the expectation is that the historical trend will continue. Looking here at the daily data points, you could make the case that this looks a bit like a potential inverse head and shoulders pattern that could develop. The primary reason for the recent breakdown is definitively this blue 100-day moving average, which has been good for the bulls, but unfortunately, the bears have been making quite a bit of money shorting that resistance level. So the blue 100-day is a huge deal. But it's not really relevant now. It's too far away. Looking at RSI and the PBOs, if you look at the previous time where we had very depressed, like green, purple, and also blue PPO on the weeklies, usually formed a bit of a low, a temporary low, that is. Looking at the daily data points, a bit noisy. I give a 4 here on the technicals to the bulls. The entry signal stop loss is definitively horizontal support. It's a huge deal. So the primary expectation now is that the bulls will use this opportunity. But there's a big caveat. If the bulls are not able to attract support at such a critical level, if major horizontal support becomes resistance, that would obviously be very good for the bears. To the right here, we get the seasonality here. The seasonality here is not really that good. Leading into the 31st of August, we usually see weakness for the TLT. We are now in the later part of August, so it means that we could get a bit more of a flush, and then let's jump to the left here. September and October are some of the weakest months. The last 10 years, from July to September, October, usually pretty weak here for the TLT. And over the last 20 years, the trend is pretty clear. We have weakening seasonality heading into October. I give the bears here a -6 on the seasonality. They have quite a bit going for them. The seasonality simply does not inspire confidence here in the bulls. Hence, even though we do have horizontal support, the bulls will feel a bit uneasy well, obviously, of course, the bulls that look at seasonality, but there is an increasing number of people who are looking at seasonality, so it's beginning to matter more. Let's compare the BNDX, which is the total, world global bond market ETF, with the TLT. Year to date, massively outperforming, relatively speaking, the TLT. Looking here at the yield, it is mediocre, 1.12% yield versus 1.60 for the TLT. Here you can see the holdings: France, Italy, US, Spain, Germany. So yeah, obviously a lot more diversification than what we get here to the right. I will give the bulls some props for the yield, but beyond that, there wasn't that much interesting here. But the key thing for the people who buy these kinds of bonds is definitively the yield. Given that we have seen this one fall to a long-term support level, you could argue that there's value here, but you can't talk about value in the same sense that you talk about it when it comes to stocks. Nonetheless, there is this phenomenon of lower levels being more attractive to bulls. So here are some correlations. We do have minus 43% with the S&P 500 long term, 78% with the BNDX, 29% with the high yield bond ETF, and you do have minus 98% with the 10-year yield. Let's look here at the daily data points. 79% here with the S&P 500, positive, very strong. And then you do have 98% with BNDX, 94% with high yield, and 98% negative here with the 10-year Treasury yield. So yeah, what happens with the 10-year yield is obviously going to have a bit of an effect on the TLT. Then again, it's very important to know that these are expectations as well. And the reason why this chart goes up and up very erratically is because there's traders. So this is not like, this is similar to like a stock. It's about expectations as well, not simply just pure indicator of the economic outlook, like in real time. Okay, anyway, looking at this chart, what I do find interesting is that there is this phenomenon of patterns repeating themselves. You have this inverse head and shoulders pattern here. You also have an inverse head and shoulders pattern here. When we look at where the recent pullback began, right here, it was at this exact level that we had back in 2018. That's interesting. So there is this general mirror effect here. Here we can see the weekly RSIs. We see that the recent rally that we had back here, it pushed us into very extreme RSI territory. The previous time we had very high RSI was back here. It did actually lead to a pretty substantial pullback. Another time where we had very high RSI was back here. That also led to a protracted pullback. So there is a possibility that we could have something similar happen again, that we will have a bit of a protracted pullback here on the 10-year yield. Given the negative correlation, that would actually be positive for the TLT. Here is the relationship between the TLT and the BNDX. We have fallen down to a support level here. The vast majority of time we have spent higher. We have been above the current level, so it's been favorable to the TLT bulls. Looking at the seasonality, we do see that weakness though, weakness into late September. So the TLT usually underperforms the BNDX significantly. Here is the relationship between the TLT and the S&P 500. The bond market is often viewed as an alternative to stocks. We have never seen this kind of underperformance from the TLT. So we do have an anomaly. We have very substantial breakdown here. Let's look a bit at the seasonality here for this. Okay, so this is potentially interesting. There, you could, at least there's an opportunity for us to form a double bull bottom in this pair, which if it becomes a double bottom, that would be favorable to the TLT. Looking here at the seasonality, we usually see some underperformance here from the TLT leading into mid-September, but then we do see some outperformance over the last 10 years in red and 7 years in blue. I give the bulls a 2 here on relative performance. We do have some data here, a bit more data that could favor the bulls. So we end up with a 0.5, which is a very low score. The key entry signal is that we are at horizontal support. Yes, obviously there is a very negative correlation between the interest rates and the bond ETF, the TLT. Then again, it's very important to be aware that the market is driven by psychology, expectations, projections. So it's not in real time. So when you hear about the Federal Reserve hiking interest rates, it's very important to be aware that it's very difficult to know what the Fed will do because they are very reactive to the market. So if the market goes too far, then the Federal Reserve will start to change the way they speak. They will go from hawkish to dovish. I mean, there's all kinds of things that they will do. So, and that in turn will have a very big effect on the TLT and the interest rates. We see something very similar here with the stock market. A lot of people, they are of the opinion that you should, be bullish on stocks, as long as the Federal Reserve has its back. There is a general trend that confirms that idea, but it isn't in real time. That's the issue. The market will react, early to what the Fed is doing. So, as such, you can't sit there, listening to the Fed meetings and then actually trade what they say on the meetings. So yeah, we do have some time left now, so let's look at some charts. Here is the S&P 500. If we go here to the daily data points, we do see that very much, unfortunately, we were rejected from the red 200-day moving average, which is a very important resistance level in this case. A huge deal. You usually say that there's a bull market above the 200-day and there's a bear market below. This is very classic bear market reaction. A bear market rally, they usually fail at these kinds of very important demarcating indicators. Here is China. Obviously, China could have a breakdown, but currently we are at the horizontal support level. Back here in 2015, 2016, major support here in 2011. Sure, we could get a breakdown that would be bad. Currently, this is an opportunity for the bulls. So interesting opportunity, potential bullish opportunity for the China stock ETF. Here is C bond. This is the China bond market ETF. We can see here this red 200-week moving average. It was support. But it has also been some pretty solid resistance. And this week we did see rejection below that very important moving average. Here you have the daily data points, and you do have this very clear downtrend on the dailies. Here is the 7 to 10 year Treasury Bond ETF. We do have some time cycles here that have a tendency to repeat themselves. And these are very major time cycles. If you look at the period here, this 2013 to 2016 rally was completely retraced. We have seen this rally between 2018 to 2020 completely be retraced here. The previous time we had a complete retracement, it usually formed a low. Well, it did form a low. which begs the question, will that pattern now repeat itself? So yeah, definitively, we do have an interesting opportunity here for the TLT, but it's extremely important that this horizontal support holds, because if it were to fail, then we would see a spectacular breakdown in the TLT, and that would have big consequences for the market, because the bond market is way more important than the stock market.